Good afternoon, everyone, and I'm delighted to welcome you to Compeer's latest webinar. And this is being jointly hosted by CREALOGIX, who are a leading system provider with expertise in the digital engagement in the wealth space. And the basis of today's webinar is the recent research that Compeer and CREALOGIX have conducted together, which is analysing the attitudes towards digital in the wealth management industry, and therefore to see how the gap can be bridged between a client's expectations and a firm's digital capabilities. And my colleague Tom will be sharing the results from a series of interviews. And then after this, I'll be delighted to be joined by our panel of senior executives from various wealth management firms, as well as CREALOGIX themselves, to answer any questions you may have. So if you would like to pose a question, please use the Q&A link at the bottom of your screen, and I'll look to get as many of these questions answered as possible during the panel session. So without further ado, though, I'm pleased to introduce Tom Thwaites from Compeer with his presentation of the research findings. So over to you, Tom.
Thank you, James. Good afternoon, everyone, and thank you all for joining us today. So as James mentioned, Compeer and CREALOGIX have been working in partnership on a joint research project looking into the attitudes towards digital across the wealth and investment management within the UK. And over the next 15 minutes or so, I'll be giving a brief breakdown of the key findings. The results of this research can be found in a full report, which you can see on screen now, which will be made available to you after today's webinar. The research itself looks at where digital can be used to enhance firms' business models, mainly for attracting and retaining clients, while we also look at the evolution of client expectations as wealth is passed down to a younger and more tech-minded generation. The project comprises of a series of interviews held with key digital decision makers across a variety of UK wealth management firms. The firms in our sample represent viewpoints from across the industry, ranging from the smaller players in the market with around 1 billion of managed assets, up to the much larger and more established firms looking after more than 30 billion of private client investments. And the combined assets under management of all the firms who took part in our survey was 90 billion, which covers slightly less than 10% of the industry's total assets. Next slide, please. So to start off with, we can have a look at some of Compeer's annual benchmarking data to see some trends in IT spend. Our data shows that IT spend for the industry has risen by almost 23% for the last 5 years to over 760 million. And as costs continue to rise over the next 5 years, we can expect this figure to exceed 1 billion by 2025. But as spending increases, the investment into technology doesn't always guarantee a strong return, as many firms are still burdened by legacy systems which prevent efficiency gains from being achieved. However, our figures do show that firms are demonstrating the value of IT investment, especially in their front offices. As you can see from the graph on screen, we have a positive link between managed assets per front office professional and IT cost per front office professional. The correlation supports the theory that if you are able to spend more on IT and digital for the front office, then it can have a positive impact on overall productivity by allowing staff to take on more and manage more clients, build their asset base, and as a result, bring in more revenue. Next slide, please. Currently in wealth management, digital is still very much in its infancy stages. The traditional practice of wealth management relies heavily on personal, face-to-face relationship and hard copy paper reports. But firms who stick to these practices are destined to be left behind as clients' demand for digital services continue to rise. All of the firms we spoke to agree on this and are undergoing some form of transformation process themselves, each with their own unique digital roadmap. As you can see from the quotes on screen, firms in our research understand the limitations of their digital capabilities and the potential loss of clients these limitations could cause. They all see digital as a way of making life as easy as possible for clients to use their services, but understand that a section of their client base, typically the older clients, still have very little demand for digital and will prefer the traditional face-to-face service which they're used to. Next slide, please. So we asked firms what they feel are their strengths and weaknesses in meeting their client expectations. And from the list you can see on screen how firms do not feel they are in a strong position to meet these expectations. On the plus side, The smaller firms feel more agile in their ability to upgrade IT systems, as it requires less disruption, which they feel gives them a competitive edge with their flexibility. While all the firms we spoke to highlight the benefits of client surveys in being able to listen and understand exactly how their clients feel about their existing service offering. And with mixed feelings towards digital, it is essential to understand how much demand from your client base there is before you implement large digital change. However, other factors make meeting these digital expectations an uphill struggle. Some feel that the quality of available systems on the market is not up to the standard they would like to see, and that buying systems off the shelf won't always solve their problems. Some think that a rigid company culture or tighter levels of regulation are constricting them and preventing them from changing. While other firms feel that an older client base, it is hard to find digitally native clients who demand the latest digital services, and therefore they feel are going to waste with such a low percentage of clients actually using the systems. Next slide, please. So to find out the most effective applications for digital, we asked firms to discuss where they feel client experience can be enhanced the most. Out of the 4 key areas on screen, client reporting came out on top, with the general feeling that current reporting standards are not high enough. The process itself is long-winded, relies heavily on manual inputs to provide static valuations. Therefore, having an automated reporting process can provide clients with an on-demand update to their portfolio, while also significantly increasing the productivity of the front office. The COVID lockdown period has also demonstrated for many the need to automate the reporting process. Some firms have required staff to come into their offices during the first lockdown period, as the task could not be completed while staff were working from home. The lockdown period also highlighted the need for a high level of self-service and client engagement to maintain the level of contact between advisor and client, and for clients to access information and news about their investments in times of heightened uncertainty. And finally, onboarding, which is also an area firms would love to have a simple, straight-through process, but due to budget constraints and regulatory issues, they're not able to offer this to their clients. They still require manual inputs at several stages of the process. Next slide, please. Consumer demand is one of the driving factors behind this digital change. We've seen a wave of technological developments in other industries which have set the bar high for tech standards. The likes of Uber, Amazon, Apple have all demonstrated how simple life can be made with cutting-edge technology powered by the likes of big data and AI. While the wealth management industry has some way to go to be on par with these tech firm standards, investors are beginning to demand more and more from their wealth providers' digital services. This, coupled with the fact that the average age of the wealth management client is declining as wealth is passed between generations, is shifting the expectations of the typical client further towards technology. Understanding the changes in client expectations is crucial to adapting your services at the right pace. Next slide, please. To effectively monitor the changes in client expectations, firms must listen to their client base and collect feedback if they wish to bridge the gap between what they currently offer and what clients want to see. We found that most firms use some form of annual client survey to measure the feeling among their client base. Compeer's own Clients View research, which covers the opinions of 1,000 end investors, found that overall, clients are pretty happy with the quality of digital offered by their wealth manager, with 76% responding either satisfied or very satisfied. However, with 22% feeling neutral about this and 2% feeling dissatisfied, there is evidently room for improvement. While everyone can agree on the benefits of running such surveys as an effective and inexpensive way to gauge client sentiment, some believe that this does not go far enough. Instead, they implement the latest analytical tools to compare feedback at every stage of the client journey. For digital tools, this means tracking usage patterns to see which areas of the service are being used and how regularly they are used in order to iron out bugs, make the systems effective and as easy to use as possible. Next slide, please. If firms can successfully transform their digital offering, they will be able to provide a client experience that the traditional business models can't compete with. But getting this right will not be easy. We asked firms to discuss what they believe are the biggest opportunities and challenges for digital in the wealth space. Among the main challenges lies COVID, which forced the skeptics to realize the value of technology and highlight the need for services such as secure messaging apps, mobile apps, document signing software, video conferencing to maintain client relationships while at a distance. While new fintech players in the market are disrupting the current level of digital standards offered by incumbent firms, this only fuels consumer expectations for the potential services they could be receiving in future. But on the other hand, there are many opportunities for technology. Among these are the ability to use massive amounts of client data to enhance their services in a similar way to the big tech firms do, in order to understand consumers to depths that simple surveys could never reach. The largest opportunity for technology, however, lies within the next generation of clients. These investors are more tech-focused and more digitally literate. Therefore, lies the potential for firms to lead the charge and stand out based on their digital offering and capture this wave of millennial clients and their assets. Next slide, please. While the potential to stand out and lead the charge exists, it turns out this is not the strategy for the majority of the industry. When we ask firms if they are using digital to stand out and act as a differentiator, or simply to meet a certain threshold and reach parity with the rest of the industry, we found that only 22% are willing to use digital as a differentiator. The reasons some gave for this is that they wish to stand out based on other factors, such as overall service quality or investment performance. But as we see margins continue to squeeze, products become more standardized, and a market full of uncertainty, will this strategy be sustainable in the long run? Of the 22% who are using digital to stand out, they say the obvious benefits of technology have been demonstrated in other industries, and they wish to get to a similar level of digital standards with them, rather than the direct competition within the wealth space. This will require heavy investment and large-scale transformation, but they feel it will bring to their clients, the value it will bring to their clients will maximize client retention and allow them to attract a much greater pool of clients with these cutting-edge services, which younger investors will become to expect as the new normal. Next slide, please. So with so many apparent benefits of technology and digital, we have to ask, what is holding the industry back? Well, the first and most basic constraint for many firms is the limitation of budgets. And with high entry costs and the damage the COVID pandemic has caused the industry, this may not change too much in the near future. Also on the financial side, firms explain that measuring the return on investment for digital can be very tricky. The returns are often realized in the long term in the form of client acquisition and can take a long time and substantial commitment to marketing and service development in addition to the technology itself in order to realize these benefits. While some are holding back on digital because they feel a large enough portion of their clients just won't use it, they understand the average age of their client is slightly older than the industry average, and as such, their clients have little use for digital. Therefore, investing heavily in this technology would, to them, feel like a waste of resources which could be spent elsewhere to more effect. So that concludes my presentation for today. I would like to say thank you all for joining us. And as already mentioned, a full copy of the report this research was based upon will be made available to you all and is also available to download directly from the CREALOGIX website. I hope you all enjoy the rest of the webinar, and I would now like to pass back to James.
Well, thank you very much, Tom, for the run-through of the findings from the research. So we'll now move on to our panel session. And so may I remind you that if you do want to pose a question, the Q&A button is at the bottom of your screen. So on our panel today, I am delighted to be joined by David Joyce, the CEO of CREALOGIX in the UK. We have Sarah Saw, the CEO of Hawksmoor Investment Management, Gareth Johnson, the head of digital channels at Brewer and Dolphin, and Ken Darmody, the head of investment management at Goodbody. So welcome everyone, and thank you very much for your time today. So let's kick off with the first question, and I'm going to start with you, David. So we see that there's a gap between client expectations and digital capabilities of the wealth management firm. So how do we actually start to bridge that gap without disappointing clients?
Well, I think that's the starting point, James. Thank you very much for the intro and thanks for the presentation, Tom. I think first and foremost, the gap that we need to make sure we fill is maintaining the loyalty of existing clients. And as the results show, whilst quite a high percentage are either satisfied or very satisfied with the solution they have, I guess there are just a couple of points. So one is, we keep on talking about this demographic time bomb, if you like, in wealth management, and I think speaking on a previous panel such as this, if we allow firms to have their digital strategy defined by a non-digital native customer base, then I think there's a real problem brewing for those firms. If you look at the ownership of mobile technology, for instance, in the UK, almost 80% of the UK own a mobile phone. And so I would sort of respectfully suggest that level of dissatisfaction or not saying they're neither satisfied nor dissatisfied is probably due to creep up. I think the second point as well is whilst it's great to see the level of satisfaction of the incumbent provider, I would guess that most firms and most clients only see their own firm's digital offering. If you go to most websites of most wealth managers, you don't get an opportunity to see their digital offering until you're a customer. And so I suppose for those that have more than one wealth management provider, they are able to do a comparison. But for many, I guess what they see is what they get. And I think as new firms come onto the market, then I'd expect to see those percentages change as consumers and certainly more digital native investors begin to see the art of the possible, if you like. So I think it's going to creep up. I think back to the original point. I think maintaining the loyalty of existing customers, and I think that means really doubling down and understanding what are the pain points for existing customers, existing clients, and how can digital help to take that pain away, whether that's through convenience, whether that's through onboarding, whether that's through paper reporting, as mentioned in the report, but really taking those first steps and trying to remove some of those pain points.
Thank you, David. And Sarah, is there anything you'd like to add?
Yeah, I think there are two things. One is I think in the past, historically, as an industry, we've tended to think as investment managers that sending our clients lots of paper, lots of valuation letters, lots of reason why letters, giving them an awful lot of information about what's going on has been seen as giving a high level of service. In fact, what we're moving to is that type of communication digitally. So trying to stay wedded into the paper world is not really not 21st century stuff. So I think clients' expectations need to be managed by the investment managers as much as for those who are unsure. And I think the comment about older people not necessarily wanting to have digital, I'm afraid like David says, 80% of people have a mobile phone. Actually, all the silver surfers all have iPads, and my 86-year-old mother could quite easily download a valuation. So I'm sure that there's a perception that the older generation don't want to use digital, but in fact, I think they do. So I think it's in the minds of the investment managers and the firms and wanting to needing to make that investment. So I think that it is up to us to drive that.
Thank you. And how about you, Gareth? How do you think the gap can be bridged?
Yeah, I think, Sarah's last point was probably one of the most important ones. I get really bored when people consistently come to me and ask, what's your millennial strategy? And they start putting digital natives out there, etc. And I get really frustrated and bored by it because, again, I think we should be looking at how do we help everyone? It's almost, instead of where's your millennial strategy, where's your octogenarian strategy? And when you look at wealth globally, we know where that sits. It's typically with, as the Americans call it, the baby boomers, the 56 to 74-year-olds. And yet we try and put all of our technology into these digital natives that might control 8%, maybe 2% of wealth. So I think we need to be better at thinking about client need and absolving ourselves of we are trying to attract digital natives, and more thinking about how do we create an inclusive wealth management system that uses technology in a wider array. And that's the bit where I think, as Sarah was talking about, we as firms, incumbents, new players, robo-advisors, brand new technology players, businesses that haven't even grown up yet need to kind of start thinking in that space rather than continue to go towards the millennial strategy, because I think that's a buzzword bingo game, digital natives and millennials.
Thank you, Gareth. And last but by no means least, Ken, is there anything you'd like to add?
Just building on Gareth's point there, I think it is interesting when a lot of the kind of profitability will be in the current businesses, in the kind of customers who are, say, silver surfers, and trying to bring your employees along is really interesting. So if everybody knows the future is going to be a different type of client, but all the employees are passionate about the current customers, how do you bring your employees along? And like what we've found is that as you try and change digital capabilities, it's actually because we're built on processes which are for historic or legacy kind of ideas, or even the culture and the mindset needs to be shifted. So I think if you can bring your employees along the journey, you'll really make a difference with your customers. And I think some of the things that we've seen is when you get a survey or you interview customers, the feedback can be positive, and you should celebrate that, especially when it's on the digital transformation journey. You need to recognize small wins for people. You'll get negative feedback, and some of it is must do, and some of it is, I'm not going to tackle that. But interestingly, even the customers are confused about sometimes what they want. So we had one situation where a younger demographic of our customers want an app, but they're not clear at all what they want in the app. And I think you have to spend time to understand what the ask is if you want to close the gap between perception and capability.
Thank you. So out of interest, staying with you, Ken, so do you feel like the digital transformation is being driven by the clients, or is it actually the staff themselves which are getting behind it and asking for the industry to move on to the next stage of the digital revolution as such?
So we believe it needs to be both. I'll probably build on just my last answer there. If it's coming from one side of the coin, you're designing with kind of somebody in mind. So, I think a lot of the discussions are about the customers, rightly so. But if you are actually only delivering for the customers, what you end up is a back end that doesn't support your staff. Your staff aren't actually in the middle of the design process, and they don't bring the most pressing issues to you. So you need to create demand on both sides. I think a lot of the research talks about it from the client impact, but we really see that when we've galvanized employees, that has made a big shift. So I know one of your kind of key areas that people are interested in is onboarding. So we re-looked at our onboarding over the last couple of years, and the actual people who innovated in that were our employees, be that people in the regulation function or people dealing directly with the customer. So one of our segments has seen their onboarding solutions reduce, and the speed to onboard reduced by 75% when volumes increased by fourfold. That would not have been done by clients alone, and it wouldn't have been done by technology alone.
Thank you. And Gareth, how about you? Brew and Dolphin, are the staff very much driving the digital change?
I think it's a mix of both, and that's always going to be the answer. We're all consumers of technology. We all use bits of technology, so we will look and aggravate and challenge inertia and do that simply as teams. I think in terms of a leadership team, we constantly encourage things like reverse mentoring. So as we bring in younger members of staff, we might start to look at how some of those things are changing and what we should be aware of. But again, our customers will always give us a view on these things. You know, we run client satisfaction surveys, as you might imagine, and they will at times tell us what is their most important point. But I think it is important always just to go and understand what's at the heart of what they're asking for. What's the thing that they want done? Rather than come and say, we're going to deliver an app, is that actually what they want in terms of an app, or is it something else? And actually having that, you know, real discussion with the client, understanding what a client's trying to do at a point often helps us. And then you have always that challenge of digitalizing the process versus making something just digital. You know, that's really truly re-engineering a process to benefit. But you've always got to have the client at the heart and use your staff as great sounding boards, challenging, frustrated individuals to kind of help move that inertia along, perhaps.
Okay, and Sarah, how about at Hawksmoor?
Well, apart from the aforementioned clients and staff, I think the other thing that's driving this is sustainability, because by going digital, we have to be as a firm and as an industry being more sustainable. So instead of knocking down half the Brazilian rainforest to send out your MiFID II quarterly valuations and all the other stuff that goes out to clients, and then getting Postman Pat to chug around the country emitting all sorts of carbon fossil fuel stuff, it has to surely be a much better way of communicating and actually doing something for the planet at the same time. And having seen the effects of lockdown 1 on our environment, I would like to think that we could make quite a big difference from a very, very paper heavy industry to a very paper light industry, and we could be very sustainable friendly in the meantime.
That's very true, and I very much hope that is the case. And David, is there anything you would like to add?
I think the points that have been raised, I completely agree with. I think it's a nuanced approach, isn't it? It's listening to your customers. It's also using the staff, the skill, the talent that you have within the business, and trying to balance those two things. I mean, as a provider of software, we can't sit back and wait to be told what customers want. We have to try and anticipate what customers want through the feedback that we get. We try to bring things to market, and I think this is an important thing for digital is try and repeat. Yeah. So you're not trying to kind of boil the ocean in one go. You try to find things, as I said earlier on, that are pain points. Whether it's, as Sarah said, taking paper out of the system. And you iterate and you listen to your customers, you listen to your staff who are great sources of information. They're also users of services. But I think that the key thing is to just keep iterating that process, keep improving the processes, and how can technology help with that on your journey.
Okay, thank you. And the wealth management industry is a highly competitive sector. We've got well over 150 firms within there. And so obviously it's very difficult to differentiate one from another. So do we believe that digital can be used as that differentiator to stand out from the market? Or is it more a case that many of the wealth management firms are going to use it to effectively achieve parity with their rival firms? And I'll start with Gareth on that one.
Thanks. I think the interesting thing with this is, if your returns are poor, if your customer service is poor, if your investment manager, your financial planner is not up to scratch, having good technology is not going to be that differentiator. We do not, I think, choose wealth management just based on technology. I think what we do have to do, though, is really understand what role it's playing. And I understand David's point about trying to anticipate consumers' needs. There's a really great graphic graphic that I'm sure many of you have seen before, and it's the front page of Forbes from November 2007. It's got a white male with his Nokia phone, and it says, Nokia, 1 billion customers. Can anyone catch the cell phone king? Those who follow telecommunications will know the iPhone launched in January 2007. And I guess if I asked everyone on the panel and the audience, I don't think many people have got a Nokia. So I think in part of this, what we have to really do is think about what we're customers trying to achieve. What's the job? Rather than just saying, can we digitize something? Can we digitize onboarding? Well, you can. You can go and digitize that tomorrow. But what is your client trying to achieve? And I fundamentally believe if you have the client at the heart of everything that you do, you'll be in a better position. But I'll also say I don't think at all clients are going to purely differentiate on technology. It's a multifaceted approach, as it should always be.
Thank you. And Ken, would you agree with that?
Yeah, I would agree with it. I don't think digital can be a differentiator in its own right, but I think a big important point is that it will be a hygiene factor. So if you want to stay in the game, you have to have digital assets. So it's probably like when you think about this intergenerational transfer, and we've all read on it, there's billions changing hands, trillions changing hands every single year for the next 30 years. It is going to go to a different type of end user. So that end user is going to be very more familiar with digital kind of tools and assets. So it's kind of like when you go into your shop, you're not open if you don't have the right digital assets. So I think it's a hygiene factor. I don't think it's a pure point differentiation, but I think what it can do, it can enable your differentiation. Like I think most of us here will respect the fact that our people kind of are a really, really important part of how we differentiate. Our brands are a really, really important part of how we differentiate. So how does digital actually enable our differentiation? And that's kind of how we would think about it.
Thank you. And Sarah, how about you?
Yeah, I think that point about enabling differentiation is a really good one, because we all want to be able to offer a very good digital service to our clients, but in order for them to see the other things that we do and do so well. But the client is at the centre of everything that we do, as Gareth has quite rightly mentioned, and digital, such as we're doing right now. I mean, it's not just about the onboarding, it's about the being able to reach out to the clients, being able to talk to them, being able to see them, just in the way that we've changed seeing clients over the last few months, has to be a positive, and that has to be for the end benefit of the client, and therefore that does help with the differentiation.
Thank you. And David, I'll slightly rephrase it for you, obviously, as a supplier to the industry. So how do you think digital can be a differentiator?
When it's done badly. I think I'd agree with everything that has been said so far. I think the digital strategy of a firm really just needs to be part of and needs to be aligned with the commercial strategy of a firm. And that commercial strategy should have the customer at its heart. I think to Ken's point that he made about it being a hygiene factor, I completely agree. And I think in terms of the differentiation, digital done badly is a differentiator, but for the wrong reasons. Poorly thought through user journeys, poorly thought through apps. I think to the point that Gareth has made a couple of times, technology for technology's sake, maybe to paraphrase it, lipstick on a pig, all those kinds of, sort of mixing metaphors, that's what can be a differentiator. But as I say, not the differentiator that some firms are looking for. To make it a differentiator, align it to your commercial strategy, think about what it is you're trying to do, and what are the unique elements that you can provide to a customer that a digital offering can do better than any other form of interaction that you have with that customer, and focus on that and execute it really well.
Thank you for that. Now, a stat that's been mentioned a few times is the satisfaction levels of clients. So we have about 75% or so saying that they were satisfied with the digital services they're receiving from the wealth manager. So this is a bit of a two-part question. First of all, do we believe that value may be inflated because the clients aren't actually aware of what could be done for them? And secondly, obviously we're in lockdown 2 now. Hopefully there won't be a lockdown 3, but there could well be. So do we think as the pandemic continues that firms will start to catch up with the expectation of clients, and so actually the number of satisfied clients will increase, or is it going to go on the reverse of that? And I'll start with Sarah. This, please.
Well, first of all, I sincerely hope there isn't lockdown 3. But I do think we're now on a journey, and I certainly think that our clients, we've seen an increasing number using our client portal because they've seen the benefits of it. So I think it is being accelerated by the pandemic, and I think firms will continue should their budgets allow. I mean, you mentioned what you did, Tom did in a couple of slides about the constraints for some firms, and they may not be able to overcome those constraints even within the pandemic. But if they can, then I think it will be a massive move forward.
And Ken, how about you?
Yeah, look, I think this is interesting. You kind of think if the dissatisfaction levels were big coming into it, that they may have got worse, because of it. But funny enough, I wonder if it's gone the other way, which is a necessity has made people fix and overcome kind of the obstacles that they had to. And otherwise, again, like you were shut down for a period of time. So, given we're all investment managers or interested in investment outcomes, we know how companies continually change and adapt to the circumstances. So I think more of us will be surprised about overcoming issues and then be surprised by how customers have interacted with us. I have a great example of an elderly couple who had to have a meeting with us. Never before would they have imagined having that virtually, but they were forced to, given the situation we found ourselves in. And as that meeting was taking place, their signal was pretty poor in their home. They went out to their hall and sat on their stairs for the meeting. And the empathy in that meeting for the relationship manager and the couple was far superior than anything that would have been in our sterilized offices that we would bring them into. So I think there's new ways that you can look at this. And I think actually satisfaction levels might shift because they will see that we'll fix a number of things that need to be fixed quickly. And therefore they will be on the same kind of track as us. So that's my thoughts on it, James.
Thank you. And Gareth, how about your thoughts on that?
Well, Lockdown 3, that difficult third movie of the trilogy. I'm not looking forward to that one. I guess the thing I'd say with this is, the question. No offense, James, kind of doesn't make sense. Consumers are satisfied, but are they satisfied and not satisfied because they don't know anything else? They're satisfied. That's the most important thing. Now, I don't say that to say we do not need to do anything. Indeed, that is definitely not what I'm trying to get at. But I think if anyone really understands consumer buying behavior, we understand there's multiple things that develop that score, and it's not just that one thing. And if it was, we'd just go and, the entire wealth management industry would not exist because we haven't got technology. So if we take that to an extreme, because the technology is not as good as the big tech, no one uses wealth management. And indeed, we're not seeing that. So I think we need to be a little bit more realistic. We need to think about how we work with consumers. And dare I even say it, the other thing is, don't move this too quickly. Because if you do, and there's some brilliant examples of this, travel companies, moving websites so quickly that the process I was really used to, I now don't understand. And because of that, that's me put off. So we can be a little bit too clever on this. We can think it's about cutting edge technology when actually it's about evolution, in my humble opinion, rather than revolution. Because I think when it's with your wealth, it's very, very different to buying a book. I think it's very different to that. It may arrive or it may not. It may come on tomorrow or it may not. This is about your future, your children's future, your grandchildren's future. And it's a little bit more important than just bringing in the latest technology.
Thank you, Gareth. And finally, David, anything to add?
Yeah, well, I'd say I would agree that last point. I think it is about, all too often, I think we come across and we have discussions with people who think that digital is this project that they kind of just do once, and therefore it is that kind of revolution, it is that kind of one-off activity. And as I said in an earlier comment, I think we see it much more as taking some steps and learning from them and addressing the issues that matter to customers. I do agree that it's not like buying a book. In fact, it's not like making a payment with a mobile app or with a contactless card. It's far more sophisticated and far more nuanced than that. But I think it's immutable, my opinion, that the pandemic has irrevocably changed the attitudes of all of us as to things that we thought couldn't be done online, that we now are being forced to do online, and I suspect we will continue to do online once the pandemic has been and gone. And so I think, let's. I hope we take the time to step back and really understand some of those things that have worked and haven't worked. The empathic client meeting on the stairs. What do we take away from that in terms of how we can make that digital interaction work really well going forward? And also, just the final thing is just let's not lose sight of, and I think this is probably where we all agree, this is just a facet of client communication. For the moment, we're being forced to use it more than we probably ever thought we would because of the pandemic, because of the health crisis. When that has been and gone, it really should be just part of an overall communication and relationship strategy where the client can use the phone, a digital channel, they can arrange a face-to-face meeting, they can have a video call. All of these things need to be bundled together. And back to the previous point, that perhaps is where the differentiation starts to come in.
Thank you. So, obviously, it looks like there is going to be change, but not necessarily instantly. So if we look 10, 20 years into the future, do we think the wealth management industry is going to be significantly different to what it is today, especially on the digital services? And I'll start with you, David. That's it.
I think 20 years out, undoubtedly. I don't think there's any industry, any sector, any type of business that won't be very, very different in 20 years' time. Will it be everything online? No, I don't think it will be. I think it will be digital. We won't even be talking about digital 20 years from now. It will be a part of not just the hygiene factor, it will be part of the DNA of almost every business sector. I think people will just expect a seamless interaction with businesses, whether it's getting financial advice, whether it's receiving their valuation reports, whether it's signing up for a new service. There'll just be an expectation that there are multiple ways and multiple channels in which they can do that. I guess the one thing that we see, don't we, from some of the new entrants to the market is that pace of change will quicken, and new services and product development will be such that I guess rather than one or two products coming to market every quarter or every year, we might see a much more nuanced and a much more kind of niche set of offerings being offered to investors on a much more regular basis, and digital will have a part to play in that.
Thank you. Sarah, how about Hawksmoor in 10, 20 years' time? How do you think the service will be different?
I think, as human beings, as we get more used to digital, we want things faster, and we get more impatient when things take time. Even if your computer is a bit slow, your patience. That form of communication, and particularly documents and stuff like that, arriving as quickly, and we will be expecting that. But it will still not take away the face-to-face requirement, and there is absolutely no doubt that as human beings we can manage working like this, but we also crave and need to see each other on a face-to-face basis. And I think Wealth, as the comment was made earlier, we're talking about one of the most important things in a person's life, their wealth, the wealth they're passing down to their children, their grandchildren, helping their children and their grandchildren to understand about wealth and teaching about it. A lot of that is done so much better on a face-to-face basis. So I think there will always be a hybrid of the two, and there will always be a desire to have the two. But in terms of delivering information and gathering information, I think that a majority will be definitely digital.
Thank you. Gareth, anything to add how you think brewing will change in 10, 20 years' time?
No change. No, I mean, I think the interesting thing here, right? The most important thing in changing human behavior is people's motivation. The pandemic has changed a lot of things because of our motivation to have that interaction that we can't have in the office. We would have went into the office. We're now doing it digitally in that moment. But I guess the thing for me is just thinking actually about how we efficiently save time for people. So if you go back 10 or 15 years and you wanted something very simple, like the valuation of your portfolio, you'd have to ring your perhaps your stockbroker, you'd have to ring them up, you'd have to have that conversation, there'd be some pleasantries, and it might be a half an hour conversation, and then something would come out in the post. You can now do that via an app. So again, I think it's really understanding the most important tasks that client want, and how do you give them back some time in their day? That's the resource none of us, no matter how wealthy you are, can create. So how do we help people with that? But at all times, it's going to be, and just echoing Sarah's comment, there's going to be people in the process. If you look to the States, Betterment and Wealthfront came together in about 2010, been around a decade. Brilliant businesses. I've spent time with Betterment in New York. Phenomenal. $22 billion under management, 500,000 customers. Fantastic. What did they do a couple of years ago? Pivoted to bring in people. This is a purely digital business. Robo-advisor, they brought in people. You look at Wealthfront, same thing. And then you look at Vanguard. So if you put Betterment and Wealthfront together, about $43 billion. That's phenomenal from nothing. Vanguard started their journey in 2015. They have 161 billion in their personal advisor services, which uses technology and people to deliver that service right across North America. And the key thing is, how do we adapt? How do we use technology to, dare I say it, augment humanity? But more pertinently, how do we help technology do the jobs that people are just inefficient, not very good at, or takes too much time? So that's the key things for me. And the signposts are already there for us, but we have to stop bringing in buzzwords, talking about revolution. It's going to be a bit of evolution over time, bringing that together, and we'll be part of that journey as well.
Thank you. And Ken, is there anything you'd like to add?
Hard to add much after some great contribution from both parties there so far. So I think like both Sarah and Gareth touched on some really important points about our business and what we're about. So like our business has been around a long, long time. And ultimately, while we talk about investments, it's really about relationships. So I think the future will still be relationships. Some of the names that Gareth mentioned are interesting. We've always followed a company called Personal Capital in the States, who actually have that hybrid approach of people and technology. And it is interesting that the pure robo people have moved more to the relationship side of it. So I think that's really important. And even lockdown has taught us that people want to be connected to each other in a different way than we kind of valued maybe a little bit before. One word of warning, I think, is if any industry or sub-industry believes they won't be disrupted, I think they're the next domino to fall. So we really have to understand, like, are we going to disrupt ourselves to stay in the game, or are we going to be disrupted by somebody who reinvents even the hybrid approach differently? So I would say to everybody to kind of focus on your core competencies and really, really understand that that's your core. I think for most of us, it's actually relationships and not investments. I think it's kind of something that we kind of do really, really well. And as we do that, think about partners in the future that you can kind of partner up with rather than see them as challengers, because they can excel in areas that you don't want as a core competency. And you can excel in areas that they'll never excel in. So I think that's really important for the future. And I think as well, think about industries outside of finance and think of industries outside of technology, because I think it's too kind of black or white. Is it technology or is it finance? So, if you think about companies like Disney and Nike, and how they endure and their brands endure and their connections with their customers endure, they still adopt technologies. They adapt with technologies. They don't always get it right. But think about companies outside of our technology and finance industries to see the future.
Thank you. And staying with you, Ken, obviously you mentioned the challenges. So under how much pressure do you currently feel from these challenges? Because they haven't made a huge inroads yet in the UK. I mean, Gareth mentioned some extreme growth rates from the US and North America, but in the UK, how much pressure do you feel under? And also, do you think this is now the time to start increasing budgets for the digital spend?
So just take your second point first, James, on the spend. And I think it was already made earlier on as well. I think it was David that made the point about the fact that like you can't pop in and pop out of digital transformation and do it for a period of time. So, you know, we're committed to a multi-decade kind of program. It can't be a few years. It's going to take a lot of investment over many different periods. Yes, you might flex that up and down when you go through periods like pandemic. Again, it's good practice. You know, if the economic times are uncertain, I think you have to be wise through that period. But over the long run, that's a small blip in a period, you know. So that's the way I would think about it. In terms of the fear or threat of disruption, I would like to think a bit about like what's actually happening. So a lot of these companies, I think, are trying to create a funnel of customers. It's a funnel of customers from a startup brand and trying to establish themselves. And like you can take examples actually that sometimes we think are disruptors in our industry. Revolut actually want probably to be, you know, the global banking partner for everybody, and yet they will drop little things into the wealth industry, and we can run around chasing Revolut if we want, but actually their competitors are the entire banking industry. And so we have to understand our competitors and what they're trying to achieve when you think about it. You know, we've actually been really, really surprised at how digital lead generation has helped us. So that's a new practice that we would have established in the last few years. Historically, our referrals and our partners who would bring business to us would be a very high proportion of our business. But we too can bring in leads similar to new companies. And actually, we already have a brand. So with our brand, our spend per customer should be a lot cheaper than companies trying to establish brands. So currently, I don't feel the threat is existential at the moment, but I think people need to be wise to what their competitors are trying to achieve.
Thank you. And Gareth, would you agree? Obviously, Bruin has a very sizable brand. So do you feel a threat in the UK? And also, do you think a lot of those American companies may come to the UK soon?
Yeah, it's a very good question. Just in terms of the Americans, I think regulation put them off. You know, that's the obvious answer. It's a piece of technology. So, you know, if you can get the tax rules correct and they're already dealing with 52 different states and you can, you know, change the currency, you could say that the tech will just come across. And it hasn't, is the obvious answer. And, you know, you see various different groups. Acorn's a good example, you know, a brilliant business out in the US. They've pulled their UK launch, not a perfect competitor, wealth management. We always look is the most important thing. We don't want to be the, dare I say it, blockbuster who just, you know, sits there in their own silo. So yes, I think you should look at all times. You know, the classic Steve Jobs quote, cannibalize your business or someone else will, is ultimately where I think we take that view. But again, it's really understanding, has something changed? Is it a trend, or has the fundamentals changed within the business? I do get frustrated when we keep saying, you know, customers want cutting edge technology. And often when we ask about some of these things, they'll say they want AI. You know, that's what they're looking at. AI was delivered in the 50s. It's not cutting edge technology. We just haven't found the client use. And it's the same in banking. You know, everyone wants open banking. Open banking are not really being used very often because we aren't. I think we've got to move away from a build it and they will come to more of about what's your customer's job to be done and how do you service that. Netflix is a great example of digital transformation. Indeed, you know, some of us are old enough to remember them posting out DVDs. But if you read that, and I'd encourage everyone to read that, Reed Hastings created the business not because he wanted to deliver content. You got annoyed with the late fee at Blockbusters. And there's something in that translates across to wealth management, understanding what is the customer actually trying to achieve. Reed Hastings wanted that DVD for a bit longer than Blockbuster wanted them to have it.
Thank you. Sarah, how much pressure do you feel Hawksmoor?
Well, quite a lot after that comment from Gareth, I must say. But of course, Hawksmoor is completely the opposite end of the spectrum from Bruins, being a very small and relatively new firm. So we have our size is also our agility, and we're young and we are investing. And I do believe that investing for this is very, very important, and investing for the future while we're a small growing company would and should pay dividends in the future. So I'm a great believer in this, and I think we are in a position where we can just take advantage of it.
Thank you, Sarah. And just to finish with you, David, so under what sort of pressure do you think the industry as a whole is from the fintech providers, and what can they do to strengthen themselves to fight off these challenges?
Right, I guess really just to echo some of what's already been said, from a provider perspective, absolutely don't want to be a business that's providing bleeding edge technology. That's not, I think any firm that is looking to do that better have very deep pockets. I think from a provider perspective, looking at and working closely with firms such as the ones represented on the panel to understand Gareth used a phrase that we use in our business, which is the jobs to be done. We really want to understand what are those jobs to be done. Firms that focus on that, I don't think need to feel pressurized, because I think they'll find that they've got a natural affinity with some of the firms that are represented here, trying to solve their problems. I think those that are off trying to solve the problems for 10 years' time, so they better have very deep pockets. So stay focused on what's important to customers right now.
Thank you, David. Being conscious of time, I'll actually draw this panel discussion to a close now. So I'd just very much like to thank all four of our panelists for their very detailed responses, and once again for your time today. Also, thank you to Tom for his presentation. Thank you for CREALOGIX for their continuous support in the running of these webinars. And also thank you very much for everyone who has logged on today, and I very much hope you found it useful. Just a reminder that the report is available on the CREALOGIX website, and also all the slides used today will be shared on the Compeer website. And we very much hope you can join us at a future webinar. But thank you once again, and have a lovely evening, everyone.